Episode 2: The Ponzi Engine. This is a forensic investigation into the systemic manufacture of artificial liquidity. In Episode 1, we deconstructed the architecture of risk and exposed the statistical fraud of the Sharpe ratio Lee. We proved that the reported stability of the $2 trillion shadow banking sector is not a product of credit quality, but a clinical exercise in volatility laundering. By the end of this hour, you will possess the forensic skill to identify the Ponzi dynamics currently sustaining thousands of insolvent corporations. You will learn to recognize the mechanics of payment-in-kind interest, the concealment epidemic that allows lenders to record profits from companies that cannot even pay their phone bills. We will reveal the round-tripping structures used to fabricate cash flow out of thin air. Most importantly, you will understand how the system uses your retirement capital to insulate institutional smart money from the inevitable impact of the 2026 maturity wall. The global financial architecture is no longer functioning as a mechanism for capital allocation. It has metastasized into a self-referential engine of survival. The continuity of the system now depends not on the cash flow generative capacity of underlying borrowers, but on the continuous injection of new debt forms to service old obligations. This is the Ponzi Engine. Chapter 6: PIK Interest, the Concealment Epidemic. To understand the crime, we must first inspect the weapon. Chapter 6 exposes the primary mechanism for hiding unserviceable debt: payment in kind, PIK interest. Section 1. The bug becomes a feature in a functional credit market. Interest is the price of time and the measure of risk. It is a cash obligation. When a borrower fails to meet that obligation, the system triggers a default, initiating a necessary restructuring. However, in the shadow ledger, this fundamental law has been suspended. The mechanism of suspension is payment in kind, or PIK. Historically, PIK was classified as a bug, a feature reserved for deep distress, high-risk mezzanine financing, or early-stage growth companies where cash was intentionally preserved for rapid expansion. It was a niche instrument of the alternative world. Today, the bug has been normalized into a primary feature of the $2 trillion direct lending market. PIK allows a borrower to satisfy its interest obligations not by transferring cash, but by issuing new debt principal. If a company owes $10 million in interest but lacks the cash to pay it, the lender simply adds that $10 million to the outstanding loan balance. The loan grows from $100 million to $110 million on paper. The borrower remains current. In reality, the company is engaging in negative amortization. This normalization represents a fundamental shift from an originate-to-hold model to an originate-to-manage model. Lenders are no longer managing credit. They are managing perceptions. By utilizing the inherent flexibility of private loan documents, they have replaced cash friction with accrued debt, effectively capitalizing the borrower's distress into the loan balance. This creates a state of synthetic stability, where the absence of volatility is purchased at the cost of increasing the ultimate severity of the inevitable fracture. The bug didn't just become a feature, it became the principal tool for the indefinite deferral of reality. Section 2: Quantitative Proliferation. The scale of this concealment is no longer anecdotal, it is a measurable epidemic. Forensic data from the 2024 and 2025 period confirms that PIK usage has reached levels that defy historical credit cycles. According to data from Lincoln International, the percentage of new private credit deals containing a PIK interest component has stabilized at a historically elevated level of 11%. This is a total inversion of the pre-2022 paradigm. In the era of low interest rates, PIK was a rarity. Today, in the higher for longer environment, it is a survival mandate. The proliferation is most visible within business development companies, BDCs, the public windows into the shadow ledger. Across the BDC sector, PIK income has doubled relative to pre-COVID levels. It now accounts for 8% to 10% of total income for the average BDC, with some funds showing concentrations as high as 15 to 20%. The industry attempts to bifurcate this data into good PIK, strategic flexibility for high-growth firms, and bad PIK, defensive liquidity preservation for failing ones. The forensic reality is damning. An analysis of the private credit deals valued by Lincoln International reveals that bad PIK remains prevalent, contributing to a shadow default rate that is roughly 3 times higher than the headline default rate. In March 2025, PIK interest income for the top 15 BDCs surged by 20% year over year, surpassing the $1 billion threshold. This billion-dollar surge in non-cash income occurred while the economy was supposedly in a soft landing. The quantitative footprint is clear. The system is amassing a massive volume of deferred distress that is growing exponentially through the effect of interest on interest. The ledger is expanding, but the cash is evaporating. Section 3. Illusory income generation. The Ponzi engine is fueled by an accounting paradox, the generation of illusory income. When a borrower toggles to PIK, the economic reality is a signal of distress. The company's debt burden is growing while its capacity to pay is shrinking. However, the lender's accounting treatment reflects this as a positive event. Under accrual-based accounting, the lender records the non-cash PIK interest as investment income on its income statement. This accrued phantom income bolsters the fund's reported yield and supports the net asset value (NAV). For a BDC, which is required by law to distribute 90% of its taxable income to shareholders, this creates a lethal liquidity mismatch. Assignment 1. This is not a drill. Pause this past day right now. Open the 10Q filing for any major BDC, such as Oaktree Specialty Lending or Ares Capital. Navigate to the consolidated statement of cash flows. Look for the line item, adjustments to reconcile net increase in net assets to net cash provided by operating activities. Search specifically for payment in kind interest income. You are looking at the exact amount of profit the fund claimed that was never actually received in cash. When you're ready, unpause. This is the core of the illusory income trap. The fund pays out cash dividends to you, the retail investor, based on these paper gains. Since no cash entered the ecosystem from the borrower, the cash for your dividend must be sourced from somewhere else, either from new capital raised from other investors or from the fund's own revolving credit lines provided by banks. This replicates the classic mechanics of a Ponzi scheme, where payouts to old investors are financed by new debt or new capital rather than the economic value generated by the underlying assets. The lender books the profit, you receive the dividend, but the borrower is a zombie, rotting from within. Section 4. The synthetic PIK round trip. As institutional investors began to scrutinize the rising PIK levels on the shadow ledger, the engine evolved. The market developed a more sophisticated opaque solution designed to circumvent internal risk controls, the synthetic PIK round trip. This structure uses a delayed draw term loan, DDTL, to manufacture the appearance of cash interest payments, thereby avoiding the PIK label entirely. Forensic deconstruction of the mechanism reveals a clinical three-step operation. The lender provides two distinct facilities to the same borrower. Facility A is the primary loan, say $100 million. Facility B is a DDTL, ostensibly for working capital or acquisitions, for $20 million. When a quarterly interest payment of $2.5 million becomes due on the primary loan, the round trip begins. First, the borrower issues a drawdown notice on the DDTL for $2.5 million. Second, the lender funds that $2.5 million into the borrower's account. Third, the borrower immediately wires that same $2.5 million back to the lender to pay the interest on the primary loan. The cash moves in a perfect, closed circle. The borrower's cash position is net zero. The debt burden increases by $2.5 million. But because the funds were physically wired, the lender records this as cash interest income, not PIK. The loan remains classified as performing and does not trigger any non-accrual flags or bad PIK warnings in surveillance reports. This is the ultimate synthetic interest payment facility, a tool used to sidestep concentration limits and keep the lights on while the foundation incinerates. Section 5. The accounting arbitrage. The synthetic PIK round trip is the ultimate expression of accounting arbitrage. It is designed to exploit the blind spots in credit surveillance. By transmuting a default signal into a cash payment, lenders successfully hide the true state of their portfolios from rating agencies, regulators, and most importantly, from the public markets. This arbitrage allows for the systematic suppression of the shadow default rate. While official default rates in private credit hover at a benign 1.8% to 2.7%, forensic analysis proves this is a mirage. When you include the soft defaults, the distressed amendments, the PIK toggles, and the DDTL round trips, the true default rate is estimated at 6.0%. The significance of this 3x divergence cannot be overstated. It means that for every visible default, there are two more hidden behind the veil of the synthetic PIK. Lenders tolerate this because a formal default forces a write-down of the asset, which would incinerate the fund's NAV and trigger redemption gates. Instead, they choose to amend and pretend, charging lucrative waiver fees and PIK premiums that generate immediate fee income for the general partner while the underlying credit quality rots. This is a world where the lender is no longer the borrower's adversary, but its co-conspirator in an exercise of valuation preservation. They are effectively buying time, gambling that interest rates will collapse before the 2026 maturity wall hits. But the arbitrage has a mathematical limit. As DDTLs are exhausted and the compounding effect of PIK interest accelerates, the can being kicked down the road becomes too heavy to move. The shadow ledger is amassing a deficit of reality that will be reconciled in a single non-linear fracture. We have now documented the mechanics of PIK interest and the round-tripping structures used to manufacture synthetic solvency. We have seen how a $1 billion surge in non-cash income is being used to pay cash dividends to unsuspecting bag holders. But the mastery of these concealment tactics naturally leads us to a more disturbing question. If the income is illusory, what is the actual operational state of the companies being sustained by these lifelines? If round-tripping sounds like a Ponzi scheme to you, tell us why in the comments. Subscribe for the next dossier. What we have just uncovered regarding the institutional concealment is bad. It confirms the systemic rot. But as we will irrefutably demonstrate for you in Episode 3, The Global Unwind, for the retail investor, the individual who believes their 401k is protected by senior secured status, it gets exponentially worse. In the next chapter, we explore the operational reality of the zombie proliferation. We will move inside the ICR less than 1.0x cohort to reveal why 1 in 4 private credit borrowers is already technically insolvent, and why the lenders are desperately betting your future solvency on a prayer that the market never closes. Chapter 7: The Zombie Proliferation. To understand the crime, we must first inspect the weapon. In Chapter 6, we deconstructed the payment-in-kind interest epidemic, the synthetic lifeline used to manufacture illusory income. Now we move inside the operational wreckage of the companies sustained by these lifelines. We are entering the domain of the zombie proliferation. This investigation proves that a significant portion of the $2 trillion shadow ledger is no longer composed of viable corporate credits, but of dead companies walking. These entities are operationally insolvent, but balance sheet performing, kept in a state of suspended animation by lenders who cannot afford to let them fail. Section 1. The ICR is less than 1.0x cohort. In a functional credit market, the primary metric of corporate health is the interest coverage ratio, ICR. This is a clinical calculation EBITDA divided by interest expense. It measures a borrower's ability to service its debt from operating profits. When the ICR falls below 1.0x, the company has crossed the threshold of technical insolvency. It is no longer generating enough cash to pay its lenders. It is burning its own foundation to exist. Forensic surveillance of the middle market in late 2024 and early 2025 reveals a terrifying structural fracture. Analysis by KBRA and Proskauer indicates that a significant minority of middle-market borrowers, estimated between 20 and 25%, are currently operating with an ICR below 1.0x. This means that 1 in 4 companies financed by the private credit sector is operationally insolvent. These companies are not merely stressed, they are zombies. The median fragility of the sector offers no comfort. The median ICR for middle-market obligors hovered around 1.5x in early 2025. While this represents a slight optical improvement from 2023 due to modest base rate cuts, it leaves a dangerously thin buffer for operational underperformance. A 15% decline in EBITDA, a standard cyclical variation, would push the median borrower to the edge of the 1.0x cliff. This is the soldier cohort of the economy, the labor-intensive cyclical firms that lack the pricing power to offset the floating rate trap. While high-margin software generals maintain healthy coverage, the soldier tail has already fallen into a cash burn cycle. The 20% to 25% cohort represents a massive hidden deficit of reality that is being hydraulically suppressed by the lenders. The system is not allocating capital to growth, it is subsidizing rot. Section 2. The shadow default rate. If 1 in 4 borrowers cannot cover their interest, logic dictates that the default rate should be 25%, yet the official narrative tells a different story. Proskauer's Private Credit Default Index reported headline default rates between 1.8% and 2.7% in mid-2025. This is the statistical mirage. This metric captures only missed payments or formal bankruptcy filings. It ignores the soft defaults that are cured through financial engineering. To expose the truth, we must apply the shadow default rate. This metric, pioneered by Lincoln International, includes distressed exchanges, PIK toggles triggered by liquidity stress, and aggressive covenant waivers. When these soft defaults are included, the true distress level in the private credit market is estimated at approximately 6.0%. The significance of this 3x divergence is absolute. It proves that realized defaults are being understated by a factor of 3 relative to the underlying economic distress. The low headline rate is not a sign of credit quality. It is a sign of extend and pretend success. Lenders are utilizing the flexibility of private loan documents to cure defaults before they hit the public ledger. This behavior creates a bifurcation in the market. The haves are performing while the have-nots, the 25% zombie tail, are being artificially sustained. This latent volatility is not being priced into the stable net asset values reported to you. Assignment 2. This is not a drill. Open the latest performance review for your alternative credit fund. Compare the reported default rate to the percentage of level 3 assets marked at par. If the defaults are 2% but 98% of the loans are at par, you are witnessing volatility laundering in real time. When you're ready, unpause. Section 4. Fee extraction from distress in a traditional banking relationship. Distress is a cost. In the shadow ledger, distress is a profit center. We must now examine the clinical mechanism of fee extraction from distress. When a borrower breaches a covenant or fails to meet a cash interest payment, the general partner, GP, does not simply help. They charge for the privilege of survival. Lenders charge lucrative waiver fees, amendment fees, and PIK premiums for every modification. These fees generate immediate fee income for the GP, often paid out of the fund's own revolving credit lines or the borrower's remaining cash. This creates a perverse incentive. The GP can actually increase its short-term profits by managing a portfolio of distressed assets rather than liquidating them. Furthermore, because the PIK interest is added to the principal balance, the assets under management, AUM, of the fund actually grows when a borrower is in distress. Since management fees are often calculated as a percentage of AUM, the GP earns higher fees from a company that cannot pay its bills than it does from a healthy one. This is zombie fee extraction. The GP is being paid to manage the rot. This misalignment of incentives is lethal for the limited partner, the retiree, whose capital is being used to fund these amendments. While the GP extracts cash fees today, the ultimate recovery value of the loan is being incinerated by the compounding effect of the debt. The GP is harvesting the yield while the bag holder inherits the loss. Section 5. The option value, gamble all, kick the can mechanisms encounter a hard mathematical boundary, the 2026 maturity wall. A massive cohort of debt originated during the zero interest rate euphoria of 2020 and 2021 is set to mature. Estimates indicate that over $620 billion in leveraged debt must be refinanced by 26. These loans originated at all-in yields of 5 to 6%. They must now be refinanced in a market demanding 10 to 12%. For the 25% of borrowers with an ICR below 1.0x, this refinancing is mathematically impossible. They cannot afford the debt they have, let alone the debt they need to stay alive. The lenders are currently engaged in the ultimate option value gamble. They are betting that a massive wave of rate cuts will arrive before the wall hits, but the math of the floating rate trap is unforgiving. If debt compounds at 11% via PIK, the total debt load doubles in roughly 6.5 years. In an environment where enterprise valuations are contracting due to higher discount rates, the loan-to-value ratio is degrading mechanically every quarter. The refinancing cliff is the event horizon of the shadow ledger. When these zombie companies hit the wall, the amend and extend tactics will run out of runway. The sponsors, who are already extracting cash via dividend recaps, will walk away rather than inject fresh equity into insolvent shells. The golden age of private credit will be reconciled in a single non-linear fracture where the designated bag holders are left at the bottom of the cliff. 1 in 4 borrowers in the $2 trillion shadow is technically insolvent, sustained only by lender forbearance and the indefinite deferral of reality. We have documented the shadow default rate and the zombie fees used to profit from distress. But the mastery of the operational rot naturally leads us to a much darker and more immediate question. If the borrowers aren't producing cash, where is the money coming from to pay your quarterly dividends? Subscribe to Macro Untold to help us track these hidden defaults before the system closes. What we have just uncovered regarding the zombie proliferation is bad. It confirms the systemic decay. But as we will irrefutably demonstrate for you in the first 10 minutes of episode 3, the global unwind, for the retail investor who believes their income is secure, it gets exponentially worse. In the next chapter, we reveal the ultimate act of financial alchemy, NAV Financing. We will show you how funds are taking on debt at the fund level to pay synthetic dividends to investors, manufacturing the appearance of performance while the foundation incinerates. This is leverage on leverage. Subscribe for the next dossier. Chapter 8: NAV Financing, Leverage on Leverage. To understand the crime, we must first inspect the weapon. In Chapter 7, we witness the zombie proliferation, the operational rot of companies that cannot cover their debt service. But the Ponzi engine requires more than just the forbearance of lenders. It requires the continuous manufacture of liquidity to satisfy the demands of the limited partners. In Chapter 8, we dissect the ultimate act of financial alchemy, net asset value, NAV financing. This is the mechanism of leverage on leverage, a structural layering of debt that represents the final, most unstable phase of the shadow ledger. Section 1: Fund Level Injection. The architectural complexity of the shadow ledger has evolved beyond simple corporate loans. Historically, private equity and private credit funds utilize subscription line facilities which are revolving credit lines secured not by the assets of the fund, but by the unfunded capital commitments of the investors. These were used as temporary bridges to smooth capital calls. However, as the credit cycle matured and exit activity, IPOs and M&A stalled in the 2023-2024 period, the industry pivoted to a more aggressive tool, NAV financing. NAV financing represents a fundamental structural shift. It is a credit facility taken on at the fund level, secured by the aggregate equity value of the entire portfolio of companies, the net asset value. Unlike a corporate loan that leverages a single company's cash flow, a NAV loan leverages the equity of companies that are themselves already highly levered. In hydraulic terms, this is the injection of a second tier of debt into a system already under extreme pressure. The mechanics are clinical. A fund manager, often through a special purpose vehicle, SPV, borrows money from a bank or a private credit hyperscaler like Apollo or Blackstone. These loans are underwritten based on the manager's own assessment of the fund's value, typically at a conservative loan-to-value WT ratio of 10% to 30%. But remember, this NAV is composed of Level 3 assets, illiquid, unrated loans valued using internal mark-to-model assumptions that have not been tested by market price discovery. The scale of this injection is no longer a niche occurrence. Forensic estimates place the NAV financing market at approximately $100 billion to $150 billion as of late 2025. Projections from firms like Ares Management suggest this market will metastasize to $600 billion or even $700 billion by 2030. This represents a systemic layering of risk, where the permanent capital of the fund is being encumbered by a senior debt claim that sits above the retiree's equity. The shadow ledger is now borrowing against its own potentially inflated opinions of value to keep the engine running. Section 2. Synthetic Distributions. Why would a manager choose to load a fund with debt? The answer lies in the distribution drought of 2024 and 2025. In a healthy market, funds return capital to investors by selling companies. But with M&A markets tepid and the deal dam frozen, managers cannot generate organic liquidity. Simultaneously, the smart money, the institutional pension funds, are over-allocated to private markets by nearly $38 billion, creating a desperate demand for cash. To solve this, managers are utilizing NAV loans for synthetic distributions. They borrow money against the portfolio to pay the investors a dividend. This is the money out trade. Forensic analysis indicates that while some NAV loans fund acquisitions, a significant and controversial portion, approximately 15% to 20% of total volume, is used explicitly to fund these synthetic dividends. This is a defining characteristic of Ponzi dynamics. The investors are receiving their own future equity value back as cash today, but that cash is burdened with interest payments on the NAV loan. The manager is essentially borrowing from the future to pay for the present. For the retail investor, these distributions feel like yield or income, but in reality, they are a return of capital funded by new leverage. Assignment 1. This is not a drill. Pause this video right now. Open the annual report for your most prominent alternative income fund, or BDC. Navigate to the section titled Distributions or Dividends. Search for a footnote regarding return of capital or debt-funded distributions. If you see that your dividend was not fully covered by net investment income, You are being paid with a synthetic distribution. You are holding a position where the manager is leveraging your own assets to pay you back your own money. When you're ready, unpause. The controversy is absolute. Organizations like the Institutional Limited Partners Association, ILPA, oppose this practice by a margin of 62% to 38%. They recognize that these fake dividends create a zero-sum game where the cash cannot be freely redeployed, and the fund's overall liquidity risk is exponentially increased. The system is cannibalizing its own future to maintain the illusion of performance today. Section 3. The IRR Alchemy. The motivation for synthetic distributions is not benevolence. It is the manipulation of performance metrics, specifically the internal rate of return, IRR. IRR is the metric used to market new funds and trigger the manager's carried interest or performance fees. Because IRR is highly sensitive to the timing of cash flows, returning capital earlier, even if it is borrowed capital, mathematically inflates the reported return. This is the IRR alchemy. Let us deconstruct the math of the lie using a forensic scenario. Scenario A. A fund invests $100 million. In year 5, it sells the assets for $150 million. The IRR is 8.45%. Scenario B. The fund takes a $30 million NAV loan in year 2 and distributes it to investors. In year 5, it sells the assets for $150 million, repays the loan plus $5 million in interest, and distributes the remaining $115 million. The total profit is lower, $145 million instead of $150 million. But the calculated IRR jumps to 10.25%. This synthetic performance improvement is not the result of superior credit selection or operational value creation. It is a mathematical byproduct of borrowing. The manager successfully manufactures a track record that appears more efficient than it is, allowing them to raise a subsequent fund from unsuspecting bag holders. The cost of the interest and the risk of the leverage are borne entirely by the investors, while the manager harvests the carried interest triggered by the inflated IRR. This alchemy creates a profound misalignment of incentives. By utilizing NAV loans, a manager can turn a mediocre fund into a top quartile performer on paper. This disguises the zombie proliferation occurring within the portfolio. While the underlying companies are struggling with an interest coverage ratio below 1.0x, the fund reports a healthy IRR, masking the fact that the foundation is being incinerated to pay for the performance. Section 4. Cross-collateralization risk. The most lethal structural flaw of NAV financing is cross-collateralization. In a traditional private credit structure, the failure of one company is isolated, but a NAV loan is secured by the aggregate value of the fund. This links the fate of healthy companies to the distressed ones. If a single significant portfolio company, a zombie, defaults and forces a valuation write-down, the fund's total NAV drops. Lenders of NAV facilities, typically senior in the capital structure, have challenge rights over the manager's valuations. If they perceive that the collateral value has eroded, they can trigger a cash sweep. This diverts all incoming cash flows from asset sales and interest payments away from the retirees and directly to the NAV lender until the debt is satisfied. In a systemic stress scenario, this creates a liquidity spiral. To repay the NAV lender and avoid a default at the fund level, the manager may be forced into a fire sale of their highest quality, most liquid assets. This leaves the remaining investors with a portfolio of inferior zombie companies, a phenomenon known as adverse selection. The healthy companies are sold to save the fund, while the rot remains. This is the hydraulic transmission of idiosyncratic risk into systemic risk. A failure in one corner of the shadow ledger, perhaps a fraud case like Tricolor, or a refinancing failure like Pluralsight, can now trigger a mandatory deleveraging of an entire fund. The cross-collateralization ensures that the contagion is not contained, it is amplified. The investor's equity cushion, which they believed was diversified across dozens of companies, is revealed to be a single, fragile layer of risk subordinated to a multi-billion-dollar fund-level loan. Section 5. The subprime parallel regulators have begun to observe these fractures with clinical concern. In December 2025, the Bank of England's Financial Policy Committee, FPC, explicitly flagged synthetic leverage and NAV financing as primary fragility channels. They categorized this layering of debt as a subprime-like risk. The parallel is precise. Just as the 2008 crisis was driven by the layering of leverage on top of subprime mortgages, the current crisis is being built by layering NAV loans on top of leveraged corporate debt. The interconnectedness is the vector of collapse. Banks are the primary providers of this fund-level leverage. U.S. banks have extended over $1.2 trillion in loans to non-depository financial institutions, NDFIs, with nearly $300 billion committed directly to private credit providers. The banking system has not de-risked. It has simply shifted from holding the asset to holding the liability of the shadow bank. If the shadow ledger valuations are found to be systematically inflated, the collateral backing these bank loans is illusory. A collapse in private credit values would trigger margin calls on these NAV facilities, transmitting the shock directly back to the balance sheets of the global systemically important banks, GSIBs. Regulators are now launching a system-wide exploratory scenario to stress test this very connection. They fear that the golden age of private credit is simply a pre-2008 shadow that has grown too large to ignore. The subprime parallel concludes with the realization that there is no lender of last resort for this layered risk. While the Fed can monetize bank assets, it has no authority to rescue an insolvent NAV facility. The retail bag holder, seduced by the IRR alchemy and the synthetic distributions, is standing at the end of a very long chain of leverage, with no public safety net to catch them when the first out bank pulls its line. We have now documented the mechanics of PIK interest, the operational reality of zombie firms, and the explosion of layered leverage through NAV financing. We have proven that the stability of the system is a product of financial engineering, not economic resilience. Have you ever received a distribution or a dividend from an alternative fund that felt too good to be true? Have you seen your income remain stable while the world around you faced a fracture? Share your investor experience in the comments below. Your intelligence is vital to this investigation. What we have just uncovered regarding the fund-level vulnerability is bad. It confirms the Ponzi nature of the current cycle. But as we will irrefutably demonstrate for you in the first 10 minutes of Episode 3, the global unwind, For the retail investor who believes their senior secured status protects them, it gets exponentially worse. In the next chapter, we provide the casualty list. We will move from theoretical risk to forensic autopsy, deconstructing the canonical failures of Pluralsight, First Brands, and Tricolor. We will show you exactly how these multi-billion-dollar accidents were engineered and why they are the leading indicators of the coming shadow bank run. Subscribe for the next dossier. Chapter 9: The Casualty List. To understand the crime, we must first inspect the weapon. In Chapter 9, we move from the theoretical to the visceral. We provide the casualty list. This is a forensic autopsy of the canonical failures that have already begun to fracture the shadow ledger. These are not isolated accidents. They are the leading indicators of a systemic decomposition. We will deconstruct the collapses of Pluralsight, First Brands Group, and Tricolor Holdings to prove that the architecture of risk is already failing under the pressure of its own leverage. Section 1. Pluralsight, the valuation fracture, the restructuring of Pluralsight, an edtech SaaS giant acquired by Vista Equity Partners for $3.5 billion in 2021, serves as the archetypal failure of the recurring revenue lending model. Historically, cash flow lending was based on EBITDA, but during the ZIRP era euphoria, lenders began underwriting loans based on top-line revenue growth. This allowed for massive debt loads that left the capital structure exceptionally vulnerable to interest rate shocks. By early 2024, Pluralsight's macro thesis had collapsed. Revenue growth slowed. Interest costs doubled due to floating rate debt. Facing a liquidity exhaustion, Vista executed a controversial drop-down maneuver, transferring valuable intellectual property into an unrestricted subsidiary to raise $50 million in new financing, proceeds that were used merely to pay interest on existing debt. This was a classic Ponzi dynamic maneuver designed to buy time at the expense of recovery value. But the most damning evidence of the crime is the valuation fracture it exposed. In Q1 2024, different lenders holding the exact same senior secured loan marked the asset at wildly divergent values. Golub Capital marked the loan at approximately 97 cents on the dollar, implying the debt was performing. Blue Owl Capital marked the same loan at 83.5 cents, signaling significant distress. Ares Capital eventually marked the position down to 48 cents. Assignment 1: This is not a drill. Pause this video right now. Open the quarterly filing for your favorite BDC. Navigate to the schedule of investments. Search for Pluralsight. Compare the mark to the current market reality. You will see a 1.4 point to 50 point spread on the identical asset. This is the statistical proof that mark to model is actually mark to magic. When you're ready, unpause. This 13.5 point spread between Golub and Blue Owl is statistically irreconcilable with an efficient market. It serves as clinical confirmation of the volatility laundering thesis. Managers utilize the discretion of Level 3 accounting to delay loss recognition, maintaining stable NAVs for their investors while the underlying credit is incinerated. The fracture proves that the golden age of private credit is built on subjective opinions of value, not market reality. Section 2. First Brands Group, the hidden leverage colossus. While Pluralsight exposed valuation subjectivity, First Brands Group reveals the terrifying scale of the shadow ledger's hidden liabilities. First Brands was constructed through a debt-fueled acquisition spree of automotive parts brands like Fram and Trico. Prior to its collapse in September 2025, the company reported approximately $6 billion in funded debt. The subsequent Chapter 11 filing revealed a staggering $5 billion discrepancy. While lenders believed they were exposed to $6 billion, the actual liabilities exceeded $11 billion. This $5 billion black hole was concealed in a labyrinth of off-balance sheet OBS financing vehicles, including accounts receivable factoring, $2.3 billion, and inventory financing through SPVs like Carnaby and Starlight. Forensic investigation by the Chief Restructuring Officer detailed a systematic fraud. The company is alleged to have engaged in double pledging the same collateral, inventory, and receivables to multiple lenders simultaneously. Furthermore, James allegedly caused the company to incur $2.3 billion in factoring liabilities based on non-existent or doctored invoices. The market reaction was a violent cliff-edge repricing. The first lien term loan, which had been trading near par at 96 cents, plummeted to 32 cents on the dollar within days. This represents a catastrophic incineration of value for a senior secured asset, defying all historical recovery assumptions. With over 1,100 CLOs holding exposure, the failure of First Brands proved that off-balance sheet debt is invisible to the system until the liquidity freezes. The hidden leverage colossus is proof that in the dark market, you never know how many people are standing in front of you in the recovery line. Section 3. Tricolor Holdings Asset Integrity Failure. The liquidation of Tricolor Holdings in September 2025 exposes the lethal interconnection between the shadow banking system and the regulated banking sector. Tricolor, a subprime auto lender certified as a community development financial institution, used AI-powered platforms to score the unscorable. But the mission-driven narrative was a facade for an asset integrity failure. Tricolor's lifeblood was the warehouse line, revolving credit facilities provided by major banks to fund loan originations before they were securitized into ABS. The fraud was clinical. Tricolor engaged in systematic double pledging, where the same car loans were pledged as collateral to multiple warehouse lenders simultaneously. By August 2025, Tricolor had pledged $2.2 billion in assets, while only possessing $1.4 billion in real collateral, an $800 million shortfall. The fallout dismantled the narrative that regulated banks had de-risked. The contagion hit the G-SIBs directly. JP Morgan Chase recorded a $170 million charge-off. Fifth Third Bank disclosed a potential $200 million impairment. Barclays reported losses of approximately $147 million. Jamie Dimon famously remarked on the earnings call, "When you see one cockroach, there are probably more." This cockroach signaling confirms that the bank private credit nexus is a direct channel for contagion. The collapse caused spreads on BBB-rated subprime auto ABS to widen by 50 basis points across the sector, as investors repriced the risk of fraud and asset integrity. Tricolor proves that bank warehouse lines are not isolated filters. They are the high-voltage wires that will transmit the shadow bank run back into the regulated system. Section 4. Sponsor Abandonment. For a decade, the private credit industry was sustained by the implied guarantee of top-tier private equity sponsorship. Lenders believed that firms like Vista Equity Partners or TPG would always inject fresh equity to protect their investments. The Pluralsight case is the layman moment that shattered this illusion. When Pluralsight's equity value hit zero, Vista did not save the company. Instead, they executed the drop-down maneuver to strip assets and then consensual handover control to the lenders. Vista Equity wrote its entire $3.5 billion equity investment down to zero, one of the largest single asset losses in private equity history. This is sponsor abandonment. In a high-rate environment, the smart money is walking away from billion-dollar car crashes rather than throwing good money after bad. Lenders who were sold low-risk contractual debt are now forced to act as operators of last resort, managing broken technology assets they are ill-equipped to run. This shift signals a regime change. The relationship between sponsors and shadow lenders has turned contentious. When the 2026 maturity wall hits and $620 billion in debt needs refinancing, don't look to the sponsors for a bailout. They are already extracting cash through dividend recaps and preparing to hand over the keys. The implied guarantee is dead. The lender is now the owner of the wreckage. Section 5. The recovery mirage, the final fracture in the shadow ledger, is the collapse of recovery expectations. Historically, senior secured debt was expected to recover 80 to 90% of its value in a default. But in the 2024 and 25 cycle, we are witnessing the recovery mirage. In the collapse of First Brands Group, the first lien term loan plummeted to 30 cents on the dollar within days of the fraud discovery. S&P now estimates recovery for first-line lenders at only 55%, while second-line and unsecured creditors face a near-certain 0% recovery. In the Tricolor liquidation, senior ABS tranches that were rated AAA traded for as little as 78 cents, and junior tranches dropped to 12 cents. Why are recoveries so low? The answer is hydraulic. Because of covenant erosion and EBITDA addbacks, companies stay alive as zombies far longer than they should. By the time a default is triggered, the underlying asset is a hollow shell. Furthermore, the lack of a liquid secondary market for private loans means that any forced liquidation becomes a thermal event, resulting in fire sale valuations. The recovery assumption of 90% is a ZIRP-era relic. The forensic reality is that senior secured assets are recovering 30% to 55%. Because the seniority is being stripped by hidden leverage and the security is being double pledged. The mirage has evaporated. The bag holders at the bottom of the waterfall are discovering that the water has been gone for years. Even the biggest sponsors are walking away from these car crashes. We have documented the valuation fractures, the hidden leverage colossi, and the total abandonment of equity by the smart money. We have proven that the recovery assumptions used to sell you these products are a mathematical fraud. Don't assume your balanced portfolio is immune. In Episode 3, The Global Unwind, we will irrefutably demonstrate that the retail investor, the individual saver who believes they are protected by seniority, is the designated exit liquidity for these failing institutional credits. We examine the AI bridge, ARR loans and circular flows. We will reveal how AI startups are using round-tripped debt to fabricate revenue and why your capital is currently funding a $2 trillion hallucination. Subscribe for the next dossier. Chapter 10: The AI Bridge. ARR loans and circular flows. To understand the crime, we must first inspect the weapon. In Chapter 10, we deconstruct the final, most speculative structural pillar of the Ponzi engine, the AI bridge. This is the mechanical nexus where the speculative fever of the Silicon Valley technology bubble is fused to the systemic fragility of the shadow ledger. We are moving inside the annual recurring revenue lending model to reveal how billions in retirement capital are currently being used to finance a $2 trillion hallucination. This investigation proves that the revenue supporting these loans is not derived from organic market demand, but from a closed-loop system of circular financing designed to manufacture the appearance of growth until the liquidity vanishes. Section 1. Underwriting the hype in the traditional architecture of credit. Lending is a function of cash flow. Lenders underwrite based on EBITDA, earnings before interest, taxes, depreciation, and amortization. This is a measure of operational reality, ensuring the borrower possesses the actual cash-generative capacity to satisfy its debt obligations. However, in the high-stakes domain of artificial intelligence and SaaS startups, this fundamental law has been suspended. Lenders have abandoned the discipline of cash flow for the speculative promise of annual recurring revenue, RA. Underwriting the hype involves a clinical departure from solvency metrics. ARR loans are structured not on what a company earns today, but on a multiple of its top-line revenue growth. In the 2024 and 25 cycle, private credit lenders, desperate for yield and pressured to deploy over $400 billion in dry powder, have aggressively embraced this model. They are underwriting loans to AI startups that have zero operational profit and in many cases no clear path to profitability. This is a capacity-driven fundraising trap. The massive hyperscalers of asset management must deploy tens of billions annually to satisfy their growth mandates. To capture volume, they have lowered underwriting standards, accepting revenue projections that ignore the existential threats of generative AI to traditional business models. The forensic reality is that these loans are unsecured bets masquerading as contractual debt. The security in these structures is not a hard asset, but a mathematical projection of growth that assumes a zero interest rate environment that no longer exists. Assignment 1. This is not a drill. Pause this video right now. Open the schedule of investments in the latest 10Q filing for a major tech-focused BDC. Search for the phrase recurring revenue loan or ARA multiple. Look at the interest coverage ratio for these specific holdings. You will find entries marked N/A or ratios below 1.0x. You are looking at debt that has no operational profit backing it. When you're ready, unpause. Section 3. The round-tripping mechanism to maintain the illusion of growth and prevent a default on the shadow ledger. The system has evolved a sophisticated engine of fabrication. The round-tripping mechanism. This is a form of circular financing derived from Hyman Minsky's Ponzi phase of instability, where the appearance of revenue is manufactured through the recycling of investment capital. The mechanics are clinical and devastating. The process involves three distinct parties: the investor, often a tech hyperscaler or large VC, the startup, and the lender, the shadow bank. Step 1. The investor injects capital into the startup as equity or debt. Step 2. The startup is then implicitly or explicitly required to use that capital to purchase products or services, such as cloud compute credits or GPUs, back from the investor or an affiliate. Step 3. The investor records this expenditure as revenue, boosting its own valuation and justifying the growth narrative. This creates a closed fake revenue loop. The startup books the expenditure as a growth investment, while the revenue returned to the investor is used to underpin the ARR metrics that the shadow bank uses to justify its loan. This is the NVIDIA CoreWeave type relationship that regulators have begun to scrutinize with clinical intensity. The revenue is not derived from organic market demand. It is a synthetic derivative of the investor's own capital injection. When the flow of speculative investment capital slows, the revenue evaporates, and the loan becomes unserviceable. This is not commerce. It is a shell game where your retirement capital is the ultimate stake. Section 4. Evaporating collateral. The fatal flaw of the ARR loan bridge is the nature of its collateral. In traditional lending, a senior secured loan is backed by hard assets, real estate, inventory, or equipment. In the world of AI and SaaS lending, the collateral is almost exclusively intangible: software, intellectual property, IP, and accounts receivable. When revenue is revealed as synthetic through round-tripping, the collateral undergoes a process of non-linear incineration. In a default scenario, the shadow bank takes the keys to a company that has no customers, no cash, and software IP that has no resale value. We saw this in the restructuring of Pluralsight, where the intellectual property was stripped away in a drop-down maneuver, leaving the original lenders holding a hollow shell. This is the recovery mirage. Lenders marketed these ARR loans as senior secured to give retail investors a false sense of safety. But seniority is irrelevant when there is nothing to be senior to. Forensic data proves that recoveries for these tech-focused assets are falling to 55%, a catastrophic departure from the historical 90% assumption. The software IP, which was marked as a trophy asset on the fund's ledger, evaporates the moment the circular revenue flow is severed. The BDC is left holding an empty shell, and the retail bag holder inherits the loss. Section 5. The Builder.ai Case Study. The 2025 collapse of Builder.ai serves as the canonical forensic dossier of this systemic failure. Builder.ai marketed itself as an AI-first platform for app development, achieving a peak valuation of $1.5 billion and securing massive debt facilities from shadow lenders who believed the ARR hallucination. The subsequent insolvency proceedings revealed a sophisticated architecture of deceit. The company was engaged in a systemic round-tripping scheme, allegedly colluding with other entities such as Versailles Innovation to generate reciprocal fake invoices. These invoices were used to fabricate the annual recurring revenue metrics required to maintain their loan covenants and draw down more cash from their lenders. The fallout was absolute. Lenders who had extended credit based on these AI-powered metrics faced total losses. The collateral, the revolutionary software IP, was revealed to be worthless phantom assets once the fake invoices were stripped away. The Builder.ai case proves that mark-to-model is often just mark-to-myth. Lenders were not underwriting a business. They were underwriting a narrative. When the narrative fractured, the billions in credit were incinerated. This is the template for the next credit cycle, a wave of tech defaults where the collateral vanishes and the shadow banking system is revealed as a provider of high-risk equity masquerading as low-risk debt. Episode 2 has deconstructed the Ponzi Engine and the AI bridge built on fabricated revenue. We have seen how PIK Interest, zombie firms, and circular flows have been used to maintain an illusion of solvency while the system is operationally bankrupt. We have proven that the $2 trillion shadow banking sector is amassing a deficit of reality that will be reconciled in a single nonlinear fracture. What we have just uncovered regarding the institutional and tech sector vulnerability is bad. It confirms the systemic rot. But as we will irrefutably demonstrate for you in the first 10 minutes of Episode 3, the global unwind, for the retail investor, the individual who believes their 401k is senior secured, it gets exponentially worse. In the next episode, we reveal the actionable protocol. We will trace the contagion to the Bermuda magic box, where your retirement checks are being laundered into profit through offshore regulatory arbitrage. We will provide the sovereign exit protocol, the specific steps you must take to protect your capital before the 2026 maturity wall hits and the system closes. Keep an eye out for Episode 3 dropping this Sunday. Don't forget to subscribe so you don't miss the next one.